All right, welcome back to capitalcompetent.com. Today I am going to go over this very important question. Is Target a buy right now? Target Corporation. Everyone knows Target, right? It's seen as the more premium Walmart, right? A higher shopping experience, a little bit more clean, but means a little bit higher prices. Okay? I just did a video on how to value a business where I go very in depth. It's one of my biggest videos where I give you a basic thought process on how to value a company. Today, I'm actually going to show you how I do it. Okay, actually going to put my money where my mouth is, and I'm going to show you how I value a business. Okay, let's get right into it. 5 things we're going to go over in this video, and this is heavily related to my previous one, and I highly recommend you go watching it. I know it's boring, I know it's not exciting, but it's very important to educate yourself because the more you know, the more you will succeed in this environment, okay, in this stock market. Today we're going to go over what is the current valuation of Target, the 5 essential metrics that I went over in my previous video, and then Target's future, what are the risks, and what I personally did. Okay? The most important question, and you can see it in my previous video, right? Does Target make money? Well, let's see. This is how I pretty much get a base case for something. Yahoo Finance, go here. I've got a ton of different researchers. I got Charles Schwab's got a good one. Uh, Robinhood actually has an excellent one, but if you want, you go to Target. Okay, this is all free. You can do this today. You go to financials, and then let's look at it. This is the income statement. So this is actually going to tell you, right, how much money is coming in. This is in the thousands. So when this says 106 million, that's 106 billion dollars of revenue. Okay, now this business is not a software business. It's a retail business. So they get products in at a cheap price and then sell it to you for a little bit higher, and that's how they make their money. Okay, is Target profitable? Well, they brought in $106 billion, but the cost of that revenue, meaning everything that goes involved selling it to you at that price at the end, is about 76 billion. Okay, so their profit margin is above 20%, which is good. Okay, that means their gross profit is $30 billion, right? And then we go down here. So that's a good, it is profitable. It is very, very profitable. Okay, not very, very, very profitable, but it's at least 25%, which is good. Okay, now the important thing, or the not so good thing, if you look at my video from yesterday, is Target is profitable. Boom, number one. Okay, that's a check. Number two, is it growing? Okay, it actually is not. It is not growing. So this company does not deserve a high multiple. Okay, it simply doesn't. You need to pay less for a company that is not growing earnings, because at the end of the day, a business is only valuable if it makes money. If the business is making less money the next year, it's not as valuable as a company that's making more money the next year. It's as simple as that. Okay, so we have a business that makes money, right? You understand the business. Everyone knows how Target makes money. They buy in bulk and then they sell it to you individually at a little higher unit price. Okay. Number three is the multiple. Okay. What is its PE? Well, you can go here and it'll show you. It's got a PE ratio of 10. Okay. Let's go back to the slideshow. Let's get rid of that. Let's go over these key metrics. Okay, what did I misspell here? What? Okay, that didn't do anything. Great. Is it a profitable business? Yes. They make about $30 billion a year in profit. Okay, profit's growing? No. Okay, so it has to trade at a discount. It has to trade lower than the market, what the market's playing. Okay, what is its current ordering? It is a 10p with a forward P of 12. This is still a huge discount. If you look at Walmart, Walmart is one of the best. They compete with Amazon. They are trading at a 41 PE and 59 for Costco. Kroger looks like a pretty good deal, actually, right? They have a 19 and they're growing revenue. Well, analysts are saying they're growing revenue. Okay, remember, the more you pay, aka higher multiple, the lower likelihood of returns. It is that simple. Okay, if you pay unbelievable prices, okay, it has to grow into that prices. The S&P PE is 25, and that includes software, which has margins of 60% or higher. Okay, those businesses earn more, so they should be worth more. Walmart and Costco are trading unbelievably high. Target is, their revenues are not growing, but they're not losing that much. It's not growing, but they are just not, they're not losing that much. So there is value. If you go to my previous video, you will see that. Okay, it is trading at a low PE currently. So it's trading at a discount. Just like valuations can be pushed really, really high, they can be pushed really, really low. Okay? So, in my personal opinion, I think this is very low, right? When you think about Target, okay, they are very new to the business that Walmart and Amazon are competing in, right? They are the industry leaders, but the core business of Target is still, I mean, they offer, Target is usually in high income areas, so they're able to charge more, right? They have a cleaner experience. It's a lot more, their shopping experience is targeted towards women with their beauty products and their beauty section, right? Target will have foot traffic, so it's not like they are going to go out of business. It will be around for the next 20 years, okay? They only have upside potential to compete with Walmart and Amazon. Now, that's going to take a lot of time. It's going to take a lot of money, okay? So its valuation is very cheap compared to how much it brings in, okay? And we see that here, right? Let's look at its debt, right? Now, you can do that by going to here, okay? This is Charles Schwab. It's very, very good. So the way that you can calculate how much debt it has, right, is take its market cap and then subtract it from its enterprise value. And that essentially is the debt, because that's what enterprise value is. It's this market cap plus debt equals enterprise value. Now, it has a ton of debt. It has $13 billion in debt, okay? That is to be expected. Okay, when you're looking at companies, you have to understand the business, right? If you're looking at a software company, they don't have a lot of overhead because they are all software, right? They're going to pay for servers and stuff, which is a high density. These Target stores have to buy each store, right? They have to lease each store, so that's debt, right? But the key that's important with this is, let's see, oh, sorry, this thing's here. Okay. My little record button's here, so I don't know if you can see that on your screen, but you go to the cash flow. Cash flow is very important, okay? So their operating cash flow, they bring that in, okay, minus their financing investments, repayment of debt, capital expenditure, okay, repayment of debt. This is all important. Their free cash flow is about 4.4 billion, which is good. That's free. Free cash flow means at the end of the year, without anything tied to it, they have 4.4 free to either buy back shares or pay down their debt, which you can see here. Okay. Now Target chooses to give that half of that out in dividends. So if we go back to here, the debt is, I don't see as an issue because it has a $4.4 billion of free cash flow, which they are paying back their leases. It's long-term leases, so they have huge obligations to the actual people who own the space, and then Target leases it out. Okay, but they have $4.4 billion in free cash flow, right? It's important to look out for, but I don't see that going away just because of how consistent it is as a business. You go to Target to buy stuff, it's a staple. It will be there. It's in high income areas. Is the dividend safe? Okay, this company owning the shares will pay you 4.6% dividend. 4.6. Okay, you can see that right here. I mean, that is a huge dividend yield just for owning the shares, just for holding it. They will give you a dividend. They will pay you each quarter $1.12 per share. That's higher than savings. That's higher than most high yield savings account. Okay. Now, you have to look out for companies that pay more than they bring in. Okay. Now, to calculate how much dividend cuts in to their free cash flow, they have free cash flow of 4.4 billion. You need to take this number, which is their annual dividend, and multiply it by the number of shares. Okay? If you multiply that, it's 2 billion. Okay? Or excuse me. Yeah, it's $2 billion. Take these shares and then multiply it by its annual dividend rate. That's 2 billion. So that means it is half of this one. I would consider that very safe. So you are guaranteed to be paid out above 4.5% in dividends, which is amazing. Okay, so you've got a cheap business, right? That's trading at a discount. It's trading below what I would pay for it, right? If the market, if they turn around, it could turn to these PEs, and then that appreciation would be crazy. Okay. Kroger looks at like a pretty good deal. They're growing revenue, but how low these PEs, it's very difficult to find something like this. Okay, that's still making money. Okay, so it makes money. The profits are not growing, so it should be a discount, right? And it is. Now, how much are you discounting? That's the difference between you and me. You have to figure out if this is worth the risk for you. For me, I think this is a fantastic multiple because that means next year it's going to be a 12 PE, which is still, to me personally, is a steal, especially with its dividend. I mean, you are guaranteed, you are guaranteed 4.4, excuse me, it was 4.6, right? Percent just for holding the shares. That's big. That's as close to guaranteed as you get. Okay, shareholder treatment. What are they doing? Are they buying back shares? Well, it looks like they are. In 2025, it looks like they have. In 2024, they did not. In 2023, they did. In 2022, they bought back a ton. Okay, now let's look at play around with this. Nope, that's the most useless tab I have ever seen. Okay. Where does it show me shares outstanding? Actually, let's look at analysis. Okay. So, their analysis, this is also what, I take a look at this, but I don't completely put all of my stake into this, but it's just interesting to see their estimates, okay? So they're expecting that they are going to lose money this year, but only down 1% and only down 1% this year, but then return in 2027. Okay. Notice how it all stays kind of around this. So they're going to be they're going to be $3 billion less in revenue. At this multiple, I think that's a pretty good deal. Okay. Their EPS estimates, okay, year over year. I mean, everything's looking good. There's nothing that's screaming no, stay away. Look at Elf over there. I sold all my shares of Elf today. That is the big. If you ever see something over 20% one day, just sell it. Just sell it, or at least get your capital out, and you can hold the rest and see where it goes. But trim your portions if you ever have. Not financial, not financial advice, of course. Can't be doing that. Okay. So they are buying back shares. So everything that I went through, plus I believe I believe the story of Target. Okay, Target to me, as I grew up, okay, Walmart was seen as not as premium as Target. If you go to Target, especially it's marketed towards girls, right? They have their huge makeup section with tons of lights, tons of product. They have higher quality, quote unquote quality products, and then you can get it for this multiple and this forward multiple with this. Is it a buy today? Well, let's go over the pros. It's a very low multiple, which is a huge pro to me. Very safe and attractive 4.6% dividend yield just for holding. And I think the story, it has a great reputation, right? Most people want to shop at Target they would prefer Target over Walmart if they had the money. Walmart is where you go when you're trying to save money. Target is where you go where you would prefer to buy. Okay, that has value. The cons is declining earnings. Okay, and they are looking at a 2027 turnaround. Okay, that is a con. If you're looking to get in and out, this is not a trading stock. This is a buy and hold. The price appreciation will likely take a while, and they have huge competition with Walmart and Amazon. But remember, Walmart and Amazon stock is extremely expensive. Or Amazon's is above 30, and Walmart's is above 40, which is extremely expensive. Okay, after all this research, these are my 5 key metrics. Okay, and then you can use these metrics and interpret it yourself. Like you can look at this and say, this is not enough of a discount. I'll buy it at a 5 PE. That is completely fair. I think 10 PE is perfect for how much I'm getting. It's all about how much you're getting out of how much you're putting in. Okay, so what did I do today? I bought 100 shares. Okay, I bought it at 94 cents a share. What I immediately did was I sold a call. If you buy 100 shares, you can sell a call, lock those shares up, and then I got paid $1,100. Now, while those shares are locked up, I still collect this nice dividend. Okay, that is the strategy that I am using. This strategy isn't for everyone, but right, 3 things will happen off of what I'm doing right here. Best case, Target hits 105 at the end of the year, and I keep my premium, my dividends, and my shares. That means I have $105. I have 100 shares of $105 stock that my cost basis is this, because when you get paid, that gets taken out of your cost basis and is added to their cost basis, which is why my shares will not be taken away from me unless it goes above these 2 added. So when he buys that from me, whoever is holding that contract, that my cost base lowers and his cost base increases. So he will not take the shares from me unless it's above 105. So my best case scenario is Target is about above $100, below 105 at the end of the year. Then I keep my premium, I keep my dividends, and my shares. That means I'm holding a $100 stock for the cost of 83, which is a great position to be in. Medium case, Target skyrockets, right? Something pops out where they're just a competitor with Amazon. They just rolled out their online shopping or whatever, and the stock just skyrockets. Every dollar that it goes above 105 goes to whoever bought my call. So I lose out on my shares, but I would keep my $1,100 that I was paid today, and I would keep that dividend rate. So I would get paid for it, and then I can reinvest that into Target for free. Okay, that's not the best case, but it's not the worst case because I still have over a 10% gain, which beats the S&P 500, which is honestly what we're all trying to do. I think that's over, if I'm doing my calculations correct, that should be about a 15% gain. So that's really good in less than a year. That's about 6 months. Worst case is Target falls below $83 a share. Sorry, let me do that. $83 a share. That's my cost basis. And I'm in the red. By that point, right, something must have happened. It could be macro events. It could be Target's earnings continue to decline, right? By that point, I'm going to have to come and reevaluate, right? Because it could be even cheap. Like I said, the multiple could fall even more just because of price action. So if it falls below 83, is it even more of a buy? Or did something change in here that I need to reevaluate? Okay. I give my best case scenario a 60% chance. My medium case at 10%, so that means 70%. I give it a 70% chance that I will make a good return on this. Worst case scenario is 30%. And the reasoning is because it takes a while to turn around a business like this or invest. They're going to take a lot of investment to bring up and compete with Walmart and Amazon. But this business is just selling so cheap. And I give it a 30% chance, honestly a little bit lower. I'd say 25, 1 out of 4. So let's just do 65. I think this is what's likely going to happen because it takes a while to turn around the business. So the price is likely range bound for a little bit. It's not going to go that much lower because of how cheap it is already, right? Value investors will snatch this up. So I don't see it going below $83, but it is possible because it is exposed to consumer spending. If we hit a recession, then it's just going to go down. So the probability is not zero. Okay, but more likely than not, it'll be my best case, which that means I would have beat the market in return and I would have kept my shares, and I would have lowered my cost basis all at the same time. This was a jam-packed video full of value, right? If you have any questions or if you'd like to let me know your thoughts, right? Thank you for watching. Thank you for giving me your time, and I want you to challenge my ideas. What do you think about this? If you like what I'm saying, like, comment, subscribe. Watch my video on how to value a company. Okay, this is how I do it. This is how I'm making money. You are confident and you have conviction, which is the most important part of investing. Thank you for watching.